I'm now pleased to introduce Mr. Mark Carney, Vice Chair of Brookfield Asset Management and Head of Transition Investing, who joins us live via Zoom. Mr. Carney is also the UN Special Envoy on Climate Action and Finance and former Governor of the Bank of England. This conference keynote will be a special conversation between Mr. Carney and IGE Chairman John. Thank you for joining us today.
It's a great pleasure to be here. Thank you very much.
Hi, Mark. Welcome to IGE conference this morning. I thought you are the most ideal speaker for this conference because we have a dual theme throughout this conference to cover. One is about climate change, the other, future of finance. Now, I couldn't think of any more qualified person to talk about these two issues at the same time. So we are so very delighted to have you today. And thank you very much for joining us live from New York. Appreciate it.
Thank you very much. And Chairman Jung, if I may just say a couple of quick words at the start, because it is a great pleasure for me to be here virtually. I wish I were with you in person, and will be there as soon as I can. But I wanted to salute the IGE and also Shinhan for your leadership over the years. First into TCFD, founding member of the Net Zero Banking Alliance, really at the heart of some of the changes that we're about to discuss. So it's incredibly important, this leadership that you have displayed. And I think it's the right thing to do to manage risk, but very much as we're going to discuss, it's also for seizing the enormous opportunities that come with the transition towards net zero.
Thank you for your kind words. Now we have about 20 minutes or so. You are extremely busy, so we would like to stick to that time frame. Now, roughly half on climate change and other half on finance, the future of finance. Now, starting with the climate change, now you're holding a special title as a UN Special Envoy on climate action and finance. Now, what is main mission or mandate as you having this very special title?
Yes. Well, so I took up this role as I ended my time as governor of the Bank of England, so about 18 months ago, on behalf of the Secretary General of the United Nations, but also on behalf of Prime Minister Boris Johnson, who, of course, the UK is the chair of COP26 this coming November in Glasgow. And the role, in terms of the objective, is simple. It's to put in place the information, the tools, and the markets so that in the private financial sector globally, every major institutional financial decision can take climate change into account. So it's partly about risk management, but it's also about seizing those opportunities. And I had a group of about 50 economists and professionals, but then there was a series of working groups staffed through the TCFD, through initiatives around voluntary carbon markets, around stress testing, other factors that extend into the thousands and are mainly from the private sector. And it's all coming together for Glasgow to have both the plumbing in place for those decisions, the information, the tools, and the markets, but very importantly alongside, and again, you've shown leadership here, the commitments of the financial sector to manage money in this direction.
Okay, just to follow up on private finance.
Yes.
Over the years, you have been emphasizing the role of private finance in facilitating transition to net zero societies. Now, could you elaborate on this a little bit? In what way and to what extent different sectors of financial industry can contribute to this important work?
Yes. Well, the first thing, and I've been working on this over the years as a public official now in this role. And to be candid, it started out about risk management, first in the insurance sector and then the banking sector, other sectors, trying to manage both the physical risks, the physical manifestations of climate change, whether that's affecting commercial real estate or supply chains or some other aspect of a business. And yeah, unfortunately, those physical events have been multiplying. I think we all know that. And if you oversee, as I did, the insurance sector, you're very aware of that. But very importantly, it's also about managing transition risk. So as we move to a lower carbon economy, who are the winners and losers? And for example, I caught the tail end of George Roberts' excellent intervention, and he was talking about the natural gas industry and the changes that, for example, every industry needs to make in order to still be competitive in a lower carbon world. So those are the two types of risks initially began. But in the last few years, it's shifted towards the scale of the commercial opportunity. And if I could leave one message from our short discussion is, this is one of the, if not the largest commercial opportunities for the next few decades, which is getting the transition towards net zero right. It is enormously capital intensive. We're talking about additional incremental energy infrastructure investment. So just one sector that's measured about $2 trillion a year, 50% of which will be in Asia. You total that up, that's an additional 2% of GDP every year of investment. It's an absolutely enormous amount. But very importantly, it's also going to bring a series of technological innovations, business process re-engineering, all in this movement towards decarbonizing. And I very strongly believe that one of the key determinants of value in the years ahead is what's the carbon competitiveness of a company? Where is it today? Where is it going tomorrow? How can it get greenhouse gas emissions down? And how can it be part of the solution as opposed to part of the problem? And we're just starting to see that come into valuations. Last point, we see that in the extremes on valuations of heavier oil, coal, fossil fuels, polluting fossil fuels versus, say, renewables, and very involved in the renewable sector, as you know. But what's going to happen is this is going to move across all assets in the financial sector. And as I said at the outset, what we're doing for COP, my role on behalf of the UN and working with the private sector, is to make sure that institutions in Asia, institutions around the world, have the information and the ability to make those judgments.
Okay, thank you. Now we have a rather ambitious plan to achieve net zero by 2050, although it varies from country to another.
Yeah.
Now, overall, would you be optimistic or pessimistic about achieving that goal in time?
Yeah, and of course it's in time. There's various ways of achieving it, and the tough question is, can we achieve it in time to limit temperature increases to 1.5 degrees, which means that we have to make significant progress over the next decade. If the harder work is left into the 2030s and 2040s, then we won't make 1.5 degrees. So it is a high bar. Now, let me give you a few reasons for optimism, all in the context of we have left this quite late and it will be challenging to do. But a few reasons for optimism. 18 months ago, when the UK assumed presidency of COP, 30% of the world's emissions were in countries that had some form of net zero target. Today, it's 75% of the world's emissions. About 300 companies 18 months ago had net zero transition plans. Now it's over 3,500 companies and growing every week. And very importantly, in the financial sector, we had no mandatory climate disclosure. You only had leaders like Shinhan and others voluntarily supporting TCFD. We've just had a G20 meeting which supported mandatory climate disclosure, and we will get mandatory climate disclosure. But very importantly, last point, is that within the financial sector, we've moved from $5 trillion of assets 18 months ago that had a net zero commitment. These are private financial assets that said they were going to manage those assets to net zero, to when we meet today, it's just under 90 trillion dollars of assets across banks, insurers, asset managers, asset owners. And so the system is moving quite rapidly to have the capital in place. Countries are making the commitments towards moving to net zero. What we need in the middle is more on the policy side to help move. And obviously that money to be put to work for investments that are going to help decarbonize.
Okay, before we move on to issues on finance, just a quick question about Brookfield Asset Management. You just joined Brookfield as vice chairman and also head of impact investing there late last year. Now, Brookfield is a global leader in the area of real estate investment. And also in Korea, Brookfield currently owns the IFC Mall in Yeouido, a huge building complex. Now, are there any initiatives on the part of Brookfield in pursuing this ESG-related investment activities?
Yes, absolutely, and that's one of the reasons why I joined. You know, Brookfield's overall strategy is very big in real estate, as you know, but also very large in infrastructure globally, and one of the largest private owners of renewable power in the world, owners and operators of renewable power. So there's $60 billion of assets under management in renewable power, over 3,000 operating employees, and 21 gigawatts of renewable power across solar, wind, hydro, storage, and another 20 gigawatts in development. So this is absolutely an enormous footprint across 4 continents. And so we've have that expertise that exists alongside the big real estate activities and the big infrastructure activities. What we also have is, and another reason why I joined, is a long legacy of ESG, managing our businesses towards ESG. And the third point I'd make, and really what cemented my joining and what I've been doing with Brookfield, is Brookfield has taken this to a new level in the course of the next year in a few ways, or in the course of the last year, in a few ways. First, we've set up a transition fund strategy, raising, we've announced an early close of over $7 billion. So it's far and away the largest fund in this area, on the way to a hard cap of the fund of $12.5 billion. The point is to go out and help companies to decarbonize. It's explicitly to go to situations where there's higher emissions and invest for decarbonization globally, also roll out renewable power. So that's one reason why I came, and that's part of the strategy. And then more broadly, Brookfield as a whole has joined the equivalent of the Net Zero Banking Alliance. It's one of the few private equity firms that have joined the Net Zero Asset Managers Alliance, which is the equivalent for asset managers. And that means we're decarbonizing and having decarbonization plans for all of our 600 billion of assets. So it's absolutely comprehensive and at the core. And we're doing it because it's the right thing to do, but we're also doing it because we think it will create enormous value across the portfolio. Okay.
All right. On that, before I forget, please say hi to Bruce Flatt.
I will.
And thanks to his great support for our conference as well. Okay. Now, let's talk about finance. Now, one of the most important emerging issues in the area of financial services sector is the big rise of big tech companies, or tech fin.
Yeah.
With a very strong platform base for their business. Now, does this present serious systemic risk in the eyes of regulators and also market participants.
Yeah.
And also, I would appreciate your comment on whether or not these companies are way overpriced these days. So I would love to have your comment on that.
Well, that's a more difficult one. It depends. It's a broad thing. But let me say, well, we get two things when we have big technological change. One is that the paradigm shift can lead to excesses in pricing, the extrapolation. So it's certainly, there are possibilities. And part of the opportunity set, I think it's related, is for very large tech companies, the question is, where are there big swaths of the economy that they can move into and play a leadership role? And certainly finance is one potential one. Now, as a regulator, you asked as a regulator, and I guess former chair of the Financial Stability Board, and I'll tell you that every time we're pro financial innovation, but the experience of financial innovation, and I can recall consumer finance liberalization back in Asia in the 80s and early 90s, and when you have those innovations, unless you're very careful, they do tend to lead to financial stability issues. That's the first point. So you have to be on top of them from the start. Second point is it's absolutely essential to have the same regulation for the same activities. So if in effect you're a tech company and you moved into banking or asset management, you should be subject to the same, in the case of the banking side, capital rules, asset management, margin rules, other prudential rules and conduct rules that are there. And that has to be done from the start, or else there's an unfair competitive advantage. The third point I'd make, though, is that it is not as clear to me that the tech companies will move all the way into they'll move a portion of the way to the consumer-facing aspect of the financial services roles, but less into the credit provision, maturity transformation, the risk management component, and they'll rely on more traditional players in the financial services sector. And I think the challenge for regulators, for businesses in the area is who is going to face the consumer. And to grossly simplify it, because we don't have that much time, if we're moving to a world where we're all deciding which wallet we use, which virtual wallet we use, are we going direct to the financial institution, or are we going via a tech company that is front-ending that financial institution? Last point is it goes back to, and it's very much related to, what's going to happen with the underlying currency structure of the economy.
Okay, all right, thank you for your comment on that. Moving on to CBDC, Central Bank Digital Currency, which has gained quite a bit of interest amongst the central banks around the world. Now, I have two parts of the question here. One, apparently China is moving faster than most other countries in developing CBDC. Now, does that present an opportunity for China to challenge dollar dominance? That's one question. Second question has to do with CBDC's implication for commercial banking business. Now, what effect would you envisage out of widespread use of CBDC?
These are
coming years. Yeah.
Dr. Chen, incredibly important questions. Let me make a couple of quick comments. First, on China's central bank digital currency and the pilot, which is, of course, quite a large pilot, being China. Yes, they have moved a bit more quickly, but it's not, the lead is not as big as it appears. one of my last acts as governor of the Bank of England 18 months ago was setting up with Christine Lagarde the working group of the core so-called G10 central banks. Ended up being the Fed is now a member of that, on central bank digital currencies for those central banks, pooling the resources, pooling the expertise and the approaches. It's been a priority of the G7 over the course of the last year, and a lot of progress is being made. Some decisions will need to be made in the next year, but it's moving more rapidly than I think is immediately apparent. But to your point on within that context, yes, the history of shift in reserve currencies is influenced first and foremost by shifts in the use of the new reserve currency as a means of payment outside of the country. So that's what happened when sterling moved to when reserves went to the dollar. It was because more and more things were priced in dollars. And the issue is, if more is priced online in renminbi, because of a digital currency, that has some on the margin effect. That said, I don't think that is what is going to happen. I think a digital dollar will be available, and I think that in a reasonable period of time, and that will reinforce for a period of time the U.S.'s reserve position. That's my view on that. In terms of banks, yes, it's an issue. It's both an issue and an opportunity for banks. It goes back to, and I know we're short on time, it goes back to the relationship with the consumer. I think the issue is, and I gave a speech on this to the BIS a few weeks ago, is that if the wallet share of the consumer is through the non-bank sector, the tech sector, I'll simplify, then there is a loss of funding for the banking sector. It gets redistributed through the wholesale sector, and it will increase the funding costs for the banking sector and maybe some of the volatility. But that doesn't have to happen, because banks that are thinking about these issues are developing the strategies, and they can still have the client relationship in a central bank digital currency world. Last point, just for the avoidance of doubt, I do not think that a central bank digital currency is going to be customer facing, retail facing. It will face the institutions themselves. So we'll have two tiers: central bank digital currency up here, the bank, the tech company, the other interface that faces the ultimate client.
Okay, great. Thank you very much. We only have a couple of minutes, and I cannot finish this conversation with you, Mark, without asking you about your new book entitled Values: Building a Better World for All. Could you tell us why we should read this book?
Yes, thank you. Well, I'm going to give you the short summary, so maybe you won't have to read it. It's called Values, and the title has a parentheses around the S, and the essence of the book is to say there's a relationship between value, so the market, and values of society, which are obviously broader than just market efficiency. They extend to solidarity and compassion and dynamism and responsibility. And that relationship goes two ways. The first, I'll just appeal to the financial crisis. When we put too much emphasis on the market, it undercuts some of the social values that support the market and ultimately has the knock-on impact. And we all lived through that experience. And the book goes through why that happened, the reforms that we've done to right it, and why it's less likely to happen, what we need to make it financial crises less likely. The other direction, though, is what we touched on at the start, which is how values of society, if people decide they want to do something and that's elevated, sustainability, getting to net zero, building a better world more broadly, but specifically net zero, then the market goes in service of that objective. And that's exactly what we're seeing now. This understanding that the world does want to move in that direction. The governments are moving in that direction. They may take a little too long, they may not do it quite right, but they're moving there. And therefore the smart money, the early money, it's not just the right thing, as you say, right behind you, do the right thing, but it's also for the, it's the effective thing. That money moves, value is created because of values. And the book goes through the strategies for that, for investing, for running companies, and including, as you would expect as a policymaker, for government policy. Okay, excellent. I'm sure your book will be sold much more here in Seoul after what you said. Okay, thank you very much, Mark, for sharing with your time and insight at our conference this morning. I sincerely hope to see you soon again, the time in person rather than virtually. Thank you very much. Absolutely. Thank you, everyone. Thank you for listening. Thanks for having me.